This week could decide whether we see a market crash or a monster rally, and it's not just hype. Let's just take a look at what CNB said.
All of the most important mega cap tech companies, and then Nvidia a little bit after that, but it's going to be big. For more on what to expect, let's welcome in Lo Tony. He's Plexo Capital's founding managing partner. It's good to see you. Welcome back.
Thanks for having me.
How do you think next week's going to unfold?
Well, I think it's going to be a bellwether for sure, because we've had so much spend. It's almost like a space race with over $300 billion in capex on mostly AI infrastructure. So I think the market's going to want to move from the promise to performance and profits.
So if this really is the turning point, then we have to know whether the biggest names are actually undervalued or in fact about to collapse. So we're going to focus on 8 major stocks that are reporting this week, running through their intrinsic value models to see which one perhaps is a screaming buy still, which one's properly priced, and which ones may tank the portfolio. And it isn't just earnings, there's also going to be perhaps a lot more volatility, as there are a few other catalysts to highlight.
There's a lot of expectations are very elevated on all 3 fronts. I think investors are anticipating bullish tech results. We're looking for not only a rate cut from the Fed, but very likely them turning off the quantitative tightening process as well. And then, Trump-Xi is a little bit more of a wild card. I think at the least investors assume status quo, where we kind of continue this detente, no fresh tariffs, they continue to talk, et cetera. An upside scenario would be some type of an incremental deal where you see maybe tariffs reduced, China buys soybeans and Boeing planes, et cetera. But that's the big wild card, I think. It's the Trump-Xi summit.
Yeah, it does certainly seem like a wild card. Do you think investors are a little too optimistic that we get to some sort of, I'm not even going to call it a trade deal, I'm going to call it a truce?
Yeah, I definitely think the risk reward into that summit is not particularly positive. If it's a detente, if it's status quo, I think that's widely anticipated. I don't think that really gives you a lot of upside from here.
And on top of that, we see the market sentiment sitting in fear. It wasn't even that long we were flickering into the extreme fear zone. And remember, this is all whilst the markets are sitting at all-time highs. So will we get that Fed rate cut this week that the market is in fact expecting? That will look to be a positive overall, but you can never take anything for granted. Will the Trump-Xi meeting go positive? We just heard the risk reward isn't looking good from the analysts. Whether or not that is something you believe in, we can see just today there has been some early positive news, and maybe a deal will get done that looks to be good for both parties. And in terms of a bit of a preview before the report next week, we can see pretty much every single big tech company is estimated to show double-digit growth, although we can see both Google as well as Amazon estimating the high single digit. And investors will want to see quite a lot of things from each of these companies. Perhaps some good news for Apple, who are due to report. The iPhone 17 is estimated to be their best-selling product in quite some time, selling 14% better in both US and China than the iPhone 16. We may also want to hear a bit from Google about the potential penetration of their moat from ChatGPT OpenAI, where they recently came up with their own web browser, although it does look like even after the share price dropped from this announcement, Google is now sitting pretty much at all-time highs. We'll also want to hear from UnitedHealth, who are reporting something that Warren Buffett, Berkshire Hathaway will be listening to very closely, as they did announce months ago they added around 5 million shares. And all of this will get us into a better place to understand if, as of today, towards the end of 2025, are we sitting in fact in an AI bubble? Because quite clearly 75% of the gains in the S&P, 80% of the profits, and 90% of the capital expenditure is all in fact coming from AI. And this has got Morgan Stanley, but as well as many analysts, very concerned. Maybe that is why we're seeing the sentiment, even at all-time highs, flickering between fear and extreme fear, because investors perhaps believe that at any point we could see quite a large correction. And as we heard earlier on, we want to understand, with all of the spending that the big tech companies are doing, are we seeing this now show up in the profits? 2.8 trillion is huge spending, and we're just talking about in the next 4 years. So as an investor, you want to know that companies can return quite a significant amount on all of this capital. And we also want to see what are the revisions potentially in this latest quarter. What is maybe the expectation for 2026? This is in fact highlighting the 2024 estimate, their January estimate, as well as July. Each company continued to revise it upwards. We can see the 2024 estimate was $235 billion. In the most recent discussions, it now sits at $363. That is a very, very significant jump. Now, as we said, we're going to run through each one very briefly, not more than a few minutes, to understand, does it look to be over or undervalued, or maybe a hold? Now, Google up 60% in the last year, up 37% year to date. Over the last 10, like many of those that we're going to cover today, has massively outperformed the S&P. It's trading pretty much at its 52-week and all-time high. Wall Street, whilst we have a buy rating, 4.49, on the cusp of a 4.5 to flip them into a strong buy. Seeking Alpha also see this as a respectable buy, 4.2 out of 5. Now their forward P does sit at 26, much higher than a historical average of 21.6, well above around 15 that we were covering on this channel not long ago, looking like a screaming buy. In fact, this one hasn't been as high as 26 on a forward P, going all the way back to around the beginning of 2022. Now, yes, in isolation, this does look like it could be potentially overvalued. And when we couple it with the blue tunnel, which as always for newer viewers highlights the intrinsic or fair price, we're now seeing it like we have done over the last month, above even the upper end of the fair price, another signal of potential overvaluation. Now look, it did spend a large chunk in the last year in undervaluation, and when we zoom out to the last 10 years, this one again is in fact, at least in the last few years, a company that has traded at quite a significant discount. Very, very rare to see Google in fact ever trade at a premium. The last time was in fact around 2020, and we can see some snippets around 2018. And they do get an F on the valuation grade. You're paying an 85% premium to the sector, but bear in mind, when we compare companies against the sector, there will be a lot of poor quality companies, and the ones we typically analyze on this channel are in fact of a high quality, so maybe less information that can be taken. But as we just highlighted, it is trading at a premium to their 5-year, about 10%. Now, more importantly, for growth companies, we like to look at the PG, price to earnings growth. Below 2, as we said, gets us excited, makes us want to dive a bit deeper. 1.74, so that's looking good. 16% premium to the sector, not much to take from there. But actually, what's very interesting to note for this company is historically it's traded PG 1.35, so you are paying a 29% premium. Just something to think about. And our valuation today gets to $229 derived from the discounted cash flow. Now we have our growth rate of 12% moving forward. It is lower than the average at 20, but higher than the most recent year at 5%. And you can see we have a low, medium, and high, including an extreme one today. But as always, these numbers that you note are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Google, or any others. Most important out of all of this is probably what is baked in right now if you're adding at an all-time high of $260. Well, it is 13.8% growth to the future free cash flows. If you believe that is too high already, you may consider this overvalued. Vice versa, you may look at this and say, actually, I believe Google can grow at a faster rate in the long term, potential undervaluation. So we use 12% with a discount rate to give us the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. 229 actually indicates downside of 12%. You may sit there and say this is way too high. Well, look, more conservatively at 10%, 199, that is 23% downside. And if you're a lot more optimistic, at 14, 263, only 1%. You may believe AI is really going to help this company grow at a much faster rate. Well, look, at 16%, $302, that is 16% upside. What we typically do, though, on the channel is take through the middle rate, which is 12%, understand what is the margin of safety on offer today. We then use an MOS of 10% where we execute buy if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. That would be at $206, which tells us today, in fact, given the share price is much higher, no MOS, you're paying a 14% premium. If you actually believe that no and MOS is what you want, well, at 10%, a buy at $206. at 20 a buy at 183, and 25 172. Wall Street, even with their very near strong buy rating, see 262 into next year. That is only 1% upside. And if you believe we're being too conservative, look, at 14%, you are in fact getting a 1% margin of safety. If you think that's more reasonable, well, at 10%, a buy at 237, at 20, a buy at 210, and 25 197. One step further for Google, you believe 16% is where this company should be heading. Well, in fact, you're getting a 14% MOS. Let us know your thoughts on Google today. Is it a buy, hold, or maybe complete avoid? And don't forget to sign up to the free weekly newsletter we have just dropped 1 minute ago, as we deliver them every single Sunday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. November's copy will drop next week. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're looking at is Microsoft, up 23% in the last year, up 24% year to date, up 900% thereabouts in the last 10. Trading not too far off their 52-week and all-time high, a strong buy rating from Wall Street, a buy but on the weaker side from Seeking Alpha, where their forward P of 34 is above, although fairly slightly, their average at 32, so another, similar to Google, potential overvaluation signal. But actually on the blue tunnel, we still see it within the upper and lower boundaries, although towards the upper end. This one not once has traded at a clear premium, but it has in fact traded at a discount during Liberation Day, although not for that long, where in fact when we zoom out to the last 10 years, Microsoft, maybe to no surprise, rarely ever trades at a discount, around 2023 in one instance and Liberation Day. Otherwise, more often than not, it does trade at a premium overall, so maybe one to consider if it does in fact come under a discount. And that is why we always say make sure you subscribe, notification bell is on. High quality companies like Microsoft, when they are severely undervalued, we will let you know. And then on the grading, they do get an F, 31% premium to the sector, 6% premium to their 5-year, but a price to earnings growth 2.9, 59% premium to the sector, historically at 2.4, so you can note a premium like Google, although for Microsoft sitting at 19%. Now, intrinsic value comes to $501. We've used 16% as the growth rate. You can see baked in is a little bit higher at 16.6. Most recent year was only a marginal free cash flow increase of 3%, and using 16%, or even if you were to use the average, which we have as the lower end, both of these do return downside. So using the middle rate does in fact show, like Google, a premium to the company of 5%, where if you do want this at a 10% MOS, a buy at 451, at 20, a buy at 401, and 25, 376. Unlike Google, where we only noted 1% projected upside, we can see Wall Street very bullish, strong buy, 632 into next year, 21% upside. Now, if you want to be in fact a lot more optimistic and believe 18% to be most appropriate, that returns an intrinsic price of 576, 9.1% MOS. Again, 10% MOS, 519 at 20, 461, and 25, 432. Let us know your views similar to Google on Microsoft today. We then move on to Meta, which is up 30% in the last year, 26 year to date. Over the last 10, up 624, trading right there at the upper end of the 52-week range and near all-time highs. Another strong buy, very similar to what we saw from Microsoft, but actually a stronger buy in terms of the rating from Seeking Alpha at 4.16. And their forward P just below 26, again like the previous two, does sit above the 5-year average of 23, another potential overvaluation signal, which is confirmed, although we would say only marginally above the upper end, but this one for quite some time has been trading at a premium overall, very rarely again during Liberation Day at a bit of a discount, where over the last 10 years, this one very, very often does trade at a very significant discount. We do notice though, at least in the last few years, this one has been trading more towards the upper end. And an F on the grading, where they're trading at an 86% premium to the sector, 15% premium to their 5-year. Price to earnings growth at 1.7 is a 13% premium to the sector overall, but actually not too dissimilar from their average, 9% above, which historically sits at 1.6. And our intrinsic value of $800 is actually derived using the lower rate for Meta at 12%, where you can notice this so far has one of the lowest growths baked in at 10.8%. Whether you use 12, 14, or 16, each one does indicate upside. Now, using the low rate of 12%, you are getting an 8% margin of safety. If you wanted 20, well, a buy at 640 and 25 at 600 on the dot. Wall Street, very similar to Microsoft, we can already see they have more faith in terms of a gain to the share price in terms of Meta and Microsoft over Google. They note 880 into next year, 19% upside. Let's use the mid rate, and that is what we classically do use. You can see you're getting a 20% margin of safety. So let us know your views on Meta platforms. We then move on to the one that Berkshire Hathaway will be closely looking at, UnitedHealth Group, down 35% in the last year, down 28% year to date. Over the last 10, still, even with the drop, it has outperformed the S&P, trading more towards the 52-week lows than 52-week highs. Huge pullback from $631, where we get a double buy from Seeking Alpha and Wall Street, both of them sitting, in fact, above 4 out of 5. Although we do notice the forward PE, like the previous companies, continuing the trend, 23 above the average at 20. And we can also see slight overvaluation. It does sit above the upper end, something we didn't note with the previous companies. The intrinsic blue tunnel has been decreasing, not something you really want to see. But when we do zoom out over the last 10 years, we can see it all in fact came in 2025. Otherwise, historically, the upward trajectory does look to continue. We've noted year to date this one has in fact started to come down, and the valuation at a B-, 19% premium to the sector, 9% premium though to their 5-year average. And our intrinsic value a little bit more complicated for the company, but the first thing we will say is if you solely want to look at a DCF like the other companies, $550, where baked in today is negative 0.2%. So let's just say no growth to their future free cash flow. However, we have used 5% moving forwards, meaning that is quite some upside if you solely want to look at this model today. Now we have two here, in fact, in terms of intrinsic values. One using all four for those that believe this company is in fact facing issues over the longer term. That in turn means you are paying a 20% premium today, no margin of safety. For those that do want to just look at the DCF and the DDM, well, $444 and 18% margin of safety. If you wanted 25%, then a buy at $333. Wall Street themselves pretty much sit around fair value today at $360, where upside is noted as -1. But let us know your views. Is UnitedHealth one to buy, one to hold, or maybe one to completely sell? We then move on to Apple, up 14% in the last year, 5% year to date. Over the last 10, up 800, trading like quite a few today at its all-time highs, around $265. Only one buy rating from Wall Street, fairly weak. The other two giving this one a hold, where we notice forward P 34, well above the 5-year average of 28, quite a clear indication of potentially severe overvaluation. And when we do look at the blue tunnel, this one is sitting above the upper end, something it has done for quite some time in the last 12 months. And also over the last 10 years, Apple does typically tend to trade at a premium, but once or twice, like Liberation Day, we can see it slip out to a very slight discount. And the valuation grading at an F, 38% premium to the sector, 24% premium to their 5-year, price to earnings growth of 3.6, near 100% premium to the sector, and a 35% premium to their 5-year average. Now, our intrinsic value at $200 solely from the DCF model is in fact using a growth rate of 8%. Now you can see reverse is 11.8. Maybe you believe that is too low or maybe too high, but generally given their growth that we have seen in terms of innovation, this one in my view is looking fairly reasonable at the low rate of 8%, which does mean downside. Even using 10%, that is also downside, a higher rate marginal at 2, but using a growth rate of 8, given the last 10 years is 7 on average, does mean if you're buying today near all-time highs, you're paying a 31% premium. Now, if you believe that's reasonable, at a 10% MOS, a buy at $180, at 20, a buy at $160, and at 25, $150. Wall Street themselves see this at $260 into next year, pretty much around this market price, no upside whatsoever. But if you believe we're being way too conservative, well look, at 10%, this means a 14% premium, and even if you believe they can grow at 12% in the longer term, you are only getting a 2% MOS. So let us know, maybe you agree, maybe you disagree about Apple today. And then we move on to SoFi Technologies, up 165% over the last year, up 88% year to date, trading very near, in fact, a 52-week high of $30. Only one buy, but extremely weak from Seeking Alpha. Wall Street and Quant do give this a hold. And if we do look over the last 4 quarters, they have outperformed in terms of their earnings. Expectation is they will again, with next quarter anticipating 70% growth to the EPS year on year. And if they do hit their target for next full accounting period, well, the forward PE does drop to around 51, where as of today, it is sitting well above the sector. You're paying a 733% premium, and price to earnings growth sitting at 3.4, a 200% premium to the sector at 1.1. Now, our intrinsic value at $24 derived from the DCF does in fact use a 15% growth rate, where baked in today is sitting at 17.9, meaning you are in fact paying a 19% premium. Wall Street themselves, even on average, see this at $26 into next year. That is downside of 10%, but maybe you disagree. You believe their growth will be much higher, and at the upper end today at 20%, this does come to around $33.53, meaning a 14% MOS. Now, we had historically done an exercise here to see what the price would be if SoFi enters into the same market cap region as PayPal, and that would be $64, meaning more than a double at 120%. But let us know your views on SoFi as well. Is it a buy, hold, or maybe one to completely avoid? We then move on to one of the worst performing stocks in the Mag 7, Amazon, up 20% in the last year, up only 2% year to date. Over the last 10, it has outperformed. It is trading a little bit below their 52-week high of $243, but a very strong buy rating from Wall Street at 4.7, a weak buy from Seeking Alpha, where like SoFi, they have outperformed in the last 4 quarters, projecting around 9 to 10% growth in this upcoming quarter. Well, over the next full accounting period, their forward P will sit just below 30, and whilst they get a D- on the valuation as they're trading at a 91% premium to the sector, they're trading at an 80% discount to their 5-year. Price to earnings growth just below 2, where that does sit at a 15% premium to the sector overall. And our intrinsic price at $228 is derived using a growth rate of 20% moving forward. Reverse DCF slightly below at 19.7. We do, however, expect their free cash flow to really ramp up once they start to slow down their capex spending, which has been extremely high, and that is where we are anticipating the efficiencies to show. As of today, though, whether you use the conservative rate of 10% or the lower 15, even the medium of 20, we are noticing very minimal upside, and in fact, on the 2 lower ends, quite significant downside. Using the 20% though, you are in fact getting a 2% MOS, where Wall Street see this 266 into next year, 19% upside. If you want a 10% MOS, a buy at 205, at 20, 183, and 25, 171. If we also take a look though at the higher end of 25%, you can see $322, indicating 31% upside. Let us know your views on Amazon today. We'll also include PayPal in the episode, which is down 14% over the last year, down 18% year to date. Over the last 10, it is up only 94%, trading towards the lower end of the 52-week range. Very weak buy rating from Wall Street, a much stronger respectable buy from Seeking Alpha at 4.3, where they've also outperformed in the last 4 quarters, expecting barely any growth EPS year on year in Q3, where in their next full accounting period, forward P is estimated to sit around 12.1, and a D on valuation as they're trading at a 23% premium to the sector, but actually 49% discount to their 5-year. Price to earnings growth at 1.2, 6% premium to the sector, but actually the lowest it's been in quite some time, a 26% discount to their historical average. Now, intrinsic value at $118 derived using a 2% growth rate highlights that baked in today is 7% decrease moving forwards. Whether you use 2, 4, or 6, we are talking significant upside, 6% in fact, more than a double. So if you believe this to be reasonable, you are getting a 41% MOS. Wall Street see $82 into next year, 17% upside, but let us know your views on PayPal. Is it a buy, hold, or complete avoid? Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.